Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is editor and publisher of thedailygold.com and the Daily Gold Premium paid newsletter. I've actually known him for over a decade. He has been covering gold and silver markets for a very long time. He has been covering mining stocks for a very long time. He is a certified market technician, which means he is an expert in technical analysis. He had to pass a very difficult test, similar to the Chartered Financial Analyst exam. Jordan Roy Byrne, thank you for joining me again.
Hey, Jason, thanks so much for that kind intro, and it's great to be on with you.
Yeah, you and me, we've known each other for over a decade. We've been through bull cycles and bear cycles in gold and silver. It's crazy. So to see these mining stocks acting like this, we'll talk about this later in the interview. I want to get your views first, though, on the global macro conditions that we have. We have crazy global macro conditions because the Fed is threatening to hike rates even more. Supposedly, there's even more rate hikes coming at the next Fed meeting, I think in the next week or so. So do you think that stocks are now in a prolonged bear market?
Jason, I think this is really the key question for so many reasons. It's also going to impact gold and precious metals, which I'll get into later. And it's something I've been talking about for the last week or so. I lean towards yes. I mean, I'm not at the point where I'm going to say, oh, it's like 100% we're going into a prolonged bear market, but I'm leaning towards yes. And I think we have to distinguish, what kind of a bear market it's going to be. And what's interesting is if you look at the worst bear markets, there's I think 6 or 7 going back to 1929. You have 1929, 1937, 1968 is one that people forget. I think it's 72, 73. Then you have 2000, 2007. So that was the start of all these really bad bear markets. And they follow a similar path, which is in the first iteration or the first leg down, they typically decline around 20%. And that can last anywhere from about 3 to 7 months. So we're following that exactly. But if you look at other corrections or mild bear markets in the stock market, they've done something similar to that. And so I think, I'm leaning towards the view that I think we're going to have a bear market rally here. And so I think the next 3 to 6 months is really going to tell us a lot. It's going to tell us, are we in a real bear market? Are we going into a recession? Because if the stock market in the next 3 to 6 months is unable to rally back to the high and make a new high, that's a pretty good sign that we're probably going into a recession. And also the chances would increase that it's going to be one of these nasty bear markets where, most of these bear markets that I mentioned, all of them, but 1968, I think was around 32%, something like that. That's the most mild out of all these cases. And the other thing that's really important, Jason, is if you look at the 40-month moving average for both gold and the S&P, just if you look at the 40-month moving average for the S&P, and you look at it, does a really good job of showing, are you in a bull market or a bear market, a secular bull or a secular bear? And so, it isn't 100% foolproof, but you can see that if you're in a secular bull, for the majority of the time, when the market has a serious correction, it comes down, but it bottoms around the 40-month moving average. Whereas if you look at, what happened in the early 70s, of course, you look at 2000 and that bear market, it was the first time in a while where the market, not only did you have a severe bear market, but the market fell below the 40-month moving average convincingly. And that usually happens after you have the bear market rally, which I think we're going into right now. So I know we're talking more technicals than global macro. On the macroeconomic side, given the way things are acting in the markets, I think we're going to have a recession coming. Maybe it's already started. And to me, it's a question of, is inflation going to come down to 4 or 5%? Or is it going to come down to 0 or 1% just because of the fact that the Fed they're being aggressive, or they want to be aggressive. The market so far is doing some work for the Fed in tightening credit spreads and stock prices and things like that. Those things are happening. And if you still have, obviously food and energy are probably going to remain high into next year. So that's going to keep inflation from really plummeting too much. Interesting to think about, are we going to fall back into a situation where, this is such a sharp recession that inflation is going to come all the way down to like 2% or 1% next year? Or is it going to stabilize around 4%? And then you're in a real stagflation. But I think either way, we're probably heading into a bear market. And I think either way, I think inflation is going to come down. Because if you look at things like even copper, the copper price, it basically peaked like roughly a year ago. It made like a new high, but it wasn't really sustained. Like it's basically been in a range. And the same thing for gold and silver. They peaked, 18 months ago, essentially. So it's basically oil and the food commodities that are keeping inflation up at this point. So I do think aside, like if you're looking at other things like used car prices and housing is going to cool off. So I think that the rate of inflation is definitely going to come down. We're seeing long bonds start to rally. So that to me is the two big questions are, how much is inflation going to come down? And then secondly, are we going into like a real significant, bear market / recession, or is it just going to be like a more mild one where we're going to be able to have some kind of soft landing next year and then we can pump in more money, and have another reflation? So I think those are the two questions.
Well, you're quoting government inflation data. The real economy, there's way worse stagflation and inflation. We're double digits here on a lot of different things. I speak to a lot of small business owners. Their costs are still going up on a lot of different items. There's shortages all over the place. The supply chains globally are still a mess. Inflation and stagflation is wreaking havoc on the real economy. It's wreaking havoc on cost structure for businesses, especially small businesses, and their profit margins. So profit margins are drastically being compressed. Margin compression, then you have a lack of free cash flow, which means that people are not reinvesting into their businesses, or they don't have, the consumer then doesn't have discretionary income.
Well, then given what you're saying, I would think that the one thing, I do follow John Williams and Shadow Stats, but for the most part, the trend of the trend in the direction of his inflation stats are similar to the government statistics. Of course, his are more accurate, but if you just look at the lines, like they're fairly similar. And so that's my, based on what you're saying, then I would think that inflation is going to come down, but then stagflation is going to be the real issue, because even the government statistics, when things come down, will still show, 4 or 5% inflation next year. And so that's obviously a real problem. So that's, I guess based on what you're saying, then I would, lean towards inflation's not going to come all the way back down to 2%. Like, it's going to remain high, but it's statistically it's going to decline. I always use that. Statistically it's going to decline, and it's a matter of how much is it going to decline. And so I think you're arguing probably not that much, that it's going to remain embedded, into next year.
Yeah, I think there's a new normal of permanently high cost structure. So even if some of these asset prices do crash, even if some of these commodities do crash, I don't think that's going to filter into the real economy and supply chains that quickly, because I'm seeing a lot of businesses, they're starting to put inflation adjustments into the contract. If you're building a new home, there's all these extra inflation adjustments into the contract for cost of materials. So do you think then, you mentioned with asset prices and a prolonged bear market, do you think a lot of this is dependent on Fed rate hikes? Because a lot of these assets were bought with credit, with margin debt by the retail trader, by hedge funds. Do you think then that the Fed increasing interest rates will decide whether or not this bear market that we have had, at least for the last couple months, that it will be prolonged?
It's hard to say as far as prolonged. I guess I didn't really specify. I guess when I think of prolonged, I think of like 2.5 years, but you can also have severe bear markets that are 18 months. I think it could be 18 months. And I think the Fed, the problem right now is the Fed, they can't do anything about oil. They can't do anything about food. They can't do anything about the supply chain problems. But tightening financial conditions that will definitely slow the economy and push the economy into recession. So that the tightening of financial conditions, that is hurting. I think that's hurting growth more so than inflation. Like, it's going to impact growth, but it's not going to have the same impact on the rate of inflation, at least initially. So
I totally agree, because they can't take the interest rates to Paul Volcker levels. I mean, if they increase interest rates another 1%, that's another $300 billion in interest payments on the national debt.
Yeah. And so I think this is, I think, and technically I've said, like, I love, not to like shift the conversation, but with respect to gold, it has this beautiful cup and handle chart, which is now, 11 years? Yeah, 11 years. It's a beautiful chart. It's a strong cup and handle pattern. Even if gold goes to 1675, it will remain well intact as a very strong pattern. And I think that it's setting up for an explosive breakout. And it makes sense that gold could have this explosive breakout when the market realizes, holy crap, inflation, the Fed has done this hiking, we're in recession, but inflation is still at 4 or 5%. Like, holy crap, what's the Fed going to do? They can't do anything. We're just going to have to, risk having like a real serious inflation. So I think that economic point that we could be leading to in the next, 6 to 9 months or so, I think that could align with or coincide with gold, making this really significant breakout. Because when you break out from that long of a base, I mean, that's really significant. I was looking at, if you just go back and you look at the stock market, the S&P, and you look at gold, I mean, there's been 2 or 3 major breakouts, and they've been really significant. They've led to long years of outperformance. I mean, the last one, you had the S&P breaking, 2000 to 2013. It broke out, had a 13-year breakout. The S&P, I think also, I want to say in the mid 1940s, it had a big breakout. And then also we know 66 to 82, the Dow. But if you're looking at gold, the early 70s, even though the price is artificially low, that was like a 35-year breakout. And then if you look at 2005, was a really significant, it had a slight downtrend where it was like a 22-year breakout, something like that. So these when you break out from like at least a decade-long base, like, that's really, really significant. And so getting back to the macro, I just think gold, this upcoming breakout, which I think will happen in the next 6 to 9 months, as I said, I think that's going to coincide with the market realizing there's really nothing the Fed can do, because stagflation is a bitch. If you have 4 or 5% inflation, a lot of this stuff is embedded, and we have no growth. I mean, there's no, we can't, there's not enough credit growth. We're in recession. The government's going to have to do fiscal stimulus and give people money. I think that's the macro that coincides with gold having this really, really significant breakout.
Yeah, where we're seeing a lot of these governments do really weird, and I would say stupid, policies where when there's food shortages or gasoline shortages or the price of gasoline's high, they're giving their own citizens checks to go buy more gasoline. So it's not dealing with the supply side problems. They're just giving people more currency to go and buy more gasoline, and it's not allowing the price to fix itself with supply and demand. But we're recording this interview on Wednesday, May 25th, 2022. Spot gold price is at $1,851 an ounce. The silver price is at $21.88 when we're recording this interview. So are your views for silver then on the charts, are they similar to gold, or do you think that silver has potentially much more downside here? As the silver miners are in a lot of trouble, Jordan. We were discussing this a couple days ago in emails. The silver miners, the profit margins, the silver miners are in much worse shape right now than the gold miners.
Yeah, I mean, if you're looking at the gold silver ratio, I mean, not to shift away from fundamentals, but if you look at the gold silver ratio, that's broken out. It has an upside target of 90. I think it's got to 86 or 87. It also has a potential measured upside target of 100. Maybe, I don't know what's going to happen in the next couple months. Maybe we'll get a panic sell-off and it'll do a spike. The sector will make a spike low and the ratio will, I don't know, maybe it spikes to 105 or 110. I'm not necessarily betting on that. I'm just saying it's a possibility. Silver, it's price in general. I mean, if you look at copper, I think copper has performed a lot better than silver. And it's kind of curious to me that silver hasn't performed better at certain points. And that if you're looking at historically, I mean, silver versus anything, if you're looking at a 100-year, 50-year chart, silver versus anything is like at a super, super low level. And I think that technically silver 1875 is a level I'm looking at. There's a lot of things like Fibonacci, super long-term moving averages. If you look on the chart laterally, that's a real significant level I'm looking at. But I think that silver is not, we were talking about mining stocks, and silver goes along with that in the fact that you're not going to see gold stocks outperform gold until gold breaks above, 2050 or 2100. And same thing with silver. Like, you're not going to see silver start to outperform gold until gold is probably at 2150 or 2200, 2300, something like that. Now, months ago, I thought 1900 was the key level. I was wrong about that. Even last year, I was looking at the charts. I thought, okay, 1900 is really the key level. If we get above that, we're going to be in the clear. But the Russia invasion kind of faked me out. The strength lasted a little bit longer than I expected, but now it's clear that it's gold breaking out to a new all-time high, 2150 or 2000 on the weekly or a monthly chart. I'd have to look at that, but it's basically when gold breaks above those levels, then I think that's when you'll start to see mining stocks outperform gold again, and that's when silver should start to pick up in terms of relative strength. But yeah, fundamentally. And I know you've been all over this out. Now, I mean, costs are increasing, but also for silver, a lot of silver companies have just been getting out of the business, and there's just not great primary silver deposits. Like, silver is mined mostly as a byproduct. And, if you look at the trend of the silver price, it hasn't really kept up with inflation. Increases in the price. I mean, the 2000s, that decade was great because you had fairly consistent rises, but if you look at the last 5-6 years, I mean, you only had 2016 where it popped for, 6 months. And then, 2019, it went up for 2 or 3 months. And then, 2020 was 4.5 months. So it's really hard to run a business with that. And so, and again, then you have the fact that there's not that many great primary silver deposits out there. And then you layer on top of that, the fact that, costs have been increasing significantly. Excuse me. So yeah, what's been happening with silver and also the mining stocks is, and this is, because people always say, oh, well, gold stocks are priced like gold is 1500 or gold's 1300 or gold's 1600. Well, the reason that is because that mirrors their margins or their profitability. Because what happens, and what we've seen in the last 17 years or so, since the early 2000s, what happens is, gold and precious metals, they make a huge run, they make a peak, and then the prices go down. But when that happens, the costs are going up while the prices go down. And so we've seen the same thing in the last 2 years or 18 months, where not only costs have gone up really fast, but look at the top line. I mean, the gold price was it was 2050 or whatever it was 2 years ago. And now it's, as you said, it's in the low 1800s. And so for silver, I mean, silver was, for a long time in the last 18 months or so, was trading around 30, upper 20s. Now it's at, $22, $21. So that's way off the high. So that's why these stocks have gotten killed, because, rising costs, in addition to the fact that the top line prices are well off the high. So that's really difficult for these businesses. But, the upside of that is when we see gold make this breakout, then, silver and these stocks are really going to fly from really, really low levels. And that's where you can see these insane upside moves that we saw in, 2020, 2016, and in the 2000s, the kind of moves that attract people to the sector. But, trying to time it and trying to figure out the macro, I mean, it's crazy, because, I mean, you could be a month or two early and, you can get cut down 30%, and then you sell out, and then suddenly the macro turns and, these silver stocks have doubled in 2 months from the bottom. So it's crazy, but I do think that things are going to turn over the months ahead.
I think in the last 12 months, silver has been one of the worst, if not the worst performing commodity. I mean, it's drastically underperformed the official government inflation rates, and it's drastically underperformed the other commodities. So to add to your points there, when you see the mining companies and you're starting to see the earnings come out now for Q1, profit margins, especially for the silver miners, and pretty much every single silver miner now has had to buy gold mines. They didn't have a choice. There were a few holdouts like First Majestic Silver in 2021 and Fortuna Silver. They bought a gold mine, and I think Endeavor Silver even bought a gold project. Those were some of the last remaining holdouts. But the ones that adapted better to this over the years, they saw this coming years ago, like Pan American Silver. They're a low-cost silver producer. They went out years ago, 6 to 8 years ago, and they started buying gold mines because they saw what you were describing with silver. They saw that coming. They saw that a lot of these future silver projects, they needed $30, $35, $40 an ounce silver. And they said, we can't do that with our business. We need gold mines because those profit margins are far safer than silver mines.
Yeah. And something I've realized now in the mid 2000s, you remember there were so many good junior silver producers. And as I mentioned before, you had a real steady bull market. A lot of the companies, the companies you mentioned, those were smaller companies that were really growing really well in the mid 2000s and into, after 2008. But because of all the factors we've discussed, so my strategy is a little different this time. I'm more focused on producers and developers that are gold companies, but on the silver side, for me, it's all about exploration companies, just because there's not that many. There's literally like zero producers at this point that I want to own. And looking at the some of the exploration companies, there's not many, but I like those because if you get into a real bull market, or you get into, a period of time where silver is really moving, those are, at least for me, those are the companies that I want to own. Whereas with gold, it's the gold. So in other words, the junior producers and junior developers in the gold space, I think that's the best bet there, versus if you're looking at juniors and silver, focus on the exploration companies, because they can get really bombed out, but they can have huge leverage. Like if silver goes from 20 to 50 in the next 2 or 3 years, that's huge leverage for these tiny companies that are just trading way off their highs. And if they have they don't even have to have a decent deposit. There was one company I won't mention, but I was looking at, it's trading at something, it's an optionality play, but it's trading at something like 20 cents for silver in the ground right now. And I could, looking at how silver exploration companies were valued at the peak, $30 silver. And I'm thinking, this, even junk silver companies could be valued at, $2 or $3 per ounce in the ground when silver goes to $50. So I think that is a more, now granted, these are, riskier companies. Whereas on the gold side, you have, the producers and the developers are going to make money. The producers are making money and cash flowing, so they're less risky. So on the silver side, which is more risky, I just like focusing on the small exploration companies, because they can, in a silver bull market, like they can really move, and they're easy for me to value, versus, on the production side for silver, like it's just, if you're a silver company, you have to produce. If you're only producing like 3 or 4 million ounces, that's just not, the market doesn't really care about those companies. Like you're not cash flowing enough money. It's something I've learned about is, which are the juniors and which are the deposits and the companies that are going to attract the industry money. Like what is the big money going to invest in? And like for them to invest in a silver producer, you have to be producing like over 10 million ounces. Like there's so many that just produce 6 or 4 or 2.5 or 3. Like it just doesn't move the needle. Like it really doesn't. So, I know I'm babbling on here, but for all those reasons, that's why for silver, I favor the really smaller companies. And for silver, you have to look at silver as more, even more of a speculation than gold. Like it's really more of a gamble, just because the quality of deposits is not there. And so the quality of companies is much stronger in the gold space.
Also, in bear market conditions for mining stocks, I mean, the equity capital can totally disappear. So if we do have a prolonged bear market in regular stocks, and then that spills over more so into mining stocks too, say the retail investor or institutional investor or the investment banks won't help with capital for a near-term developer that has maybe a feasibility study on a mine, the capital available to build a mine or to help the junior move forward, that can disappear very quickly. So you don't think then that some of these juniors, and I know you've been through bear markets too in mining stocks with me, the 2015 bear market was one of the worst ones. A lot of the larger mining companies, they had no profit margin. They could not get any more debt from the banks. They couldn't raise equity capital from retail investors or institutional investors. No one wanted any exposure to mining stocks back then. But do you think then that some of these juniors then will get bought for pennies on the dollar if this bear market in mining stocks, if metals prices don't rise and there's not bull market conditions?
Well, I think that there could be a lot of industry consolidation, and also a lot of juniors are not going to move until, like, now granted, most quality juniors, they'll probably bottom when gold bottoms, and silver will probably bottom at the same time. But then it gets back to gold really needs to break to a new all-time high to call it 2100, needs to break above 2100 for money to really start coming in. But so the point I'm getting at here is a lot of the gold, like, you can have a sector bottom and gold rallies back to 2100, but a lot of these junior companies, like, their stocks won't necessarily really move that much. Like, they need like 2400 gold for money to start pouring in. So I guess what I'm just saying is there doesn't necessarily have to be a prolonged bear market for these companies to be to be impacted. Like, they can still be hurting even when the market has already turned, because first and foremost, the money is going to go into senior royalty companies, other royalty companies, and producers, growth oriented producers, also developers that have quality projects.
Also, gold stock.
All the money is going to go into those places first, and then it doesn't go into a lot of exploration juniors until, again, gold's like at 23 or 2400.
The other part of that puzzle there is tons of liquidity. So trading liquidity. So this is big institutional capital, high frequency trading, algorithm money from hedge funds and other institutional investors. It doesn't necessarily go into individual stocks, Jordan. It goes into these gold stock ETFs and gold mining stock ETFs. So if you are a large mining company or royalty company and you're in one of those gold stock ETFs, there's a big, big advantage. And if you're not in one of those gold stock ETFs, it's a disadvantage in that scenario too.
Yeah, and you also can get hurt with, when there's rebalancing and that type of thing. So, I mean, I try and find, my goal is to find the companies that will go into the GDXJ in the future. But I mean, your point is well taken, and that's, big money. They can only invest in juniors, the smaller juniors with private placements, basically. So yeah, they have to, they basically have to buy the bigger stocks and the ETFs.
Well, Jordan, I really enjoyed our conversation today. I want to thank you very much for your time. I think my listeners learned a lot about bear markets. So I know you've traded these bear markets. If we could, one more question before I let you go. Is there any particular things that my listeners should avoid in a bear market for trading bear markets that you think is important?
Well, I think that you want to cut losers. And you want to be really patient. So I like to cut losers at 20%. I mean, I think of like a 5% position. If you're using a 20% stop loss, you're risking 1% of your portfolio. I mean, if it's a 3% position, you can risk 30%. So I think that's really important. And then secondly, I think that company, at least it applies everywhere, but for gold and silver especially, like, company selection is really important. You want to try and learn everything you can about these companies, and you want to try and own the companies that are going to rebound first, and not, if you just have some random juniors that are not really moving the needle and you're just hoping, gold's going to go to 3,000, like I was saying before, those types of companies, it's going to take a long time for those to get back to their highs, versus if you own the right, if you own companies that are generating cash flow and growing, or they have really good deposits, it can be okay to hold those, because when when the market will turn for gold and silver, and it will turn aggressively. When that happens, those stocks can rebound very, very quickly. So yeah, it's, have a plan for, cutting your losses, and then really focus on stock selection and try and find the companies that are really going to do the best. They're going to be first out of the gate when, gold rebounds and breaks out, because you don't want to get stuck with just random companies that have poor fundamentals and you're just really hoping that, this thing will go to the moon when gold hits 4,000. Like, I think that's going to happen in the next couple of years, but you don't want to have to wait for, 12 or 18 months to break even.
I agree. And if metals prices do go down temporarily, but costs keep rising with electricity costs and energy costs, the cost to build a mine is up in some countries over 50% in the last 2 or 3 years. In that short time period, you could see some of these mining stocks, they could go negative on their profit margins. They could be at zero profit margin or negative temporarily. And then the management team might not have access to capital. You could see the management team panic and potentially sell out the company for pennies on the dollar to a larger low cost miner that has a better balance sheet. Jordan and I have seen this many, many times over the years in bear market cycles with mining stocks, where we picked out potentially a company with a good deposit, and then all of a sudden they're selling out the asset for pennies on the dollar because the conditions of the market, the management team couldn't raise capital. The management team didn't want to risk it. They wanted shares of a larger, safer mining company that was a low-cost producer. So the low-cost miners, if you identify them, they will survive this regardless of what happens with this bear market. In the short term, the juniors, the upside is more obviously, but there's always the risk then of the company, if they're not a good deposit, if you misidentify them, they could go bankrupt, or the management team could sell them out for pennies on the dollar.
Yeah. And one more thing, I'm glad this popped into my head, because I was thinking I wanted to mention this, when you invited me on. And the one thing with cost inflation, it's really interesting. The cost inflation and cost pressures, it's killing companies, especially in North America. So a lot of, even someone like Rick Rule, I mean, he will invest in a lot of these jurisdictions that people don't necessarily like. I mean, I don't mind investing in Africa and these other places. You really have to study what's going on there, and study the people and all of that. But the cost inflation in Canada and the US is it's so much worse than what you're seeing, at least so far, like in Africa or South America, for example. It's just something I realized in the last week. I mean, if you've probably seen some of these studies. If you look at studies for companies, PEAs and PFS, pre-feasibility studies, feasibility studies that are coming out for companies in Canada and the US. I mean, the cost inflation in North America is really, really bad. So if, you might have to open up your horizon a little bit and look at some other jurisdictions. Because if you're the type of investor where you're saying, I'm only going to invest in safe jurisdictions like North America, right now you're really getting killed on the margins there.
I agree. And Nevada is actually trending down lately. I mean, a lot of these gold mines in Nevada, whether it's the one for First Majestic Silver, America's Gold and Silver, the Relief Canyon, or Barrick Gold, they're Nevada gold mines. Like, all the production results coming out, the costs are drastically going up. So there's big red flags in Nevada with costs. The costs are, the last 3, 4, 5 years, are going out of control, especially during the pandemic. And there's shortages too. A lot of these items in North America, shortages for key things needed to maintain property, plant, and equipment, or to build a new mine.
Yeah, absolutely. I mean, as one junior mining executive told me, there's really no good jurisdictions anymore. He said everything has gotten, a little bit worse or a lot worse in the last 20 years, depending on where you are. But you have to, So with respect to jurisdictions, don't be afraid to go outside North America, because these miners in these other places, at least to this point, they're handling cost creep much better. I mean, it's just been so much worse in North America. Some of these cost numbers are insane in North America right now.
Or if you own shares in a royalty and streaming stock ETF like GOAU, or you own individual shares of like the larger royalty and streaming companies, you don't have to worry about this as much. You don't have to worry if all your mining company shares hedged their diesel costs, or if their electricity costs have doubled over the last 2 or 3 years in a particular area, because they have diesel generators. So you don't have to worry about all these things. The royalty and streaming companies, they have lower costs, they have better business models, they tend to be more diversified than a regular mining company.
That's right.
Well, Jordan, I really enjoyed our discussion today. I want to thank you so much for your time. If my listeners want to follow your work, how do they do so?
They can go to thedailygold.com. I publish a lot of free stuff there. I do free videos, free interviews. I also interview people and check out my YouTube channel. I'm going to update my book and I'm going to put the videos or the chapters on YouTube because they have a lot of charts. Yeah, check out my YouTube channel and also thedailygold.com. A lot of free info there.
And again, thank you so much for your time. Hopefully we'll have you back on and gold and silver prices will be a lot higher.
Sounds good. Thank you so much for having me. I really enjoyed it.